Ladies and gentlemen, economic turbulence, fiscal merry-go-rounds, and job numbers that tell tall tales, that's your global economy nowadays. This week, the Federal Reserve seems ready to lower interest rates again, like a doctor prescribing Tylenol for a brain hemorrhage. Sure, a quarter-point rate cut looks helpful on paper because, steadying the ship, but does anyone really believe that's going to fix the Titanic of issues currently plaguing the U.S. economy? Let's start with the official data. A couple of hurricanes hit the U.S., Boeing halted some operations, and voila. Payroll numbers supposedly take a nice little dip to a modest gain of 110,000. But remember, these numbers are always fudged around the edges. We're told the unemployment rate stays at 4.1% and inflation, mind you, is accelerating again, even faster than expected. The accelerator here is the Personal Consumption Expenditures, PCE, price index growing at its fastest pace in 5 months. So much for the Fed's confidence in cooling inflationary pressures. But don't worry, the narrative stays the same, temporary, temporary, temporary. Or as a smart person once said, temporary every time is just permanent waiting to happen. Thursday's data shows consumer spending looks strong, like America is doing just fine. But let's tear off the band-aid for a second. This is a consumer base surviving on debt and not the good, leverage for growth kind of debt. We're talking credit card max-outs, buy now pay later schemes gone haywire, and personal savings rates at multi-decade lows. Consumers are not spending because they're optimistic. They're spending because they have no other choice, with inflation biting into their day-to-day purchases. Friday's jobs report is going to be critical, and we expect some serious excuses when the payroll increase misses the mark. 2 hurricanes, Boeing work stoppages, that's the shiny packaging. But peel it open, and the engine of the labor market simply isn't roaring anymore. And now, the critical question, does a 0.25% cut in rates give these workers back their jobs? Does it soothe inflation expectations? Or is the Fed careening toward irrelevance, doing little more than locking itself in a cyclical pattern of cutting rates without addressing core, systemic flaws in the economy? Now, here's the punchline. GDP is forecasted to maintain a solid pace at 3% annualized for Q3. Somehow, they want us to believe this is the economy's strength. They hail robust consumer spending as if it's a good thing. But no one's reckoning with the underlying rot. Inflation-adjusted wages are stagnant or falling, and future outlooks for business investment aren't exactly rosy either, especially in a time when the Fed's so awkwardly balancing recession risk by lowering interest rates. These numbers won't tell you that behind the curtains, businesses are tightening their investment plans due to both high borrowing costs, thanks to previous rate hikes, and continued uncertainty over the consumer's ability to drive growth sustainably. Sure, the government's releasing metrics showing a rise in business outlays, but let's be clear, equipment investments today may very well be future overproduction bills. As the consumer slows down to catch its breath, businesses will soon figure out the demand isn't there. I wouldn't blink twice if we see a string of disappointing inventory run-ups by Q1 2024. Now, while the US tries to steady its listing ship, elsewhere in the world, we've got full-on economic rain dances and fiscal foolery going on. Chancellor Rachel Reeves over in the UK is getting ready to deliver her first budget under the newly elected Labour government. The talk is grand, comparing the situation to post-war reconstruction in 1945 or the technological revolution of 1964. But what she won't say aloud. The UK economy is in a slow-motion train wreck. GDP growth is feeble, cracking under the weight of lingering Brexit chaos, inflation that keeps hovering near 6%, housing market instability, and of course, lackluster productivity. The dream of targeted investments will face sharp realities when the government moves to restructure rules and leans on additional borrowing. Good luck finding investors when pound confidence remains shattered. Any bets on UK tax hikes coming fast and furious? You heard it here first. Across Europe, are we ready to call a spade yet? Germany, the economic engine of the continent, is in an outright recession. But you wouldn't hear fiercely nationalist politicians in Berlin admit that. Meanwhile, robust growth in Spain and, drumroll, Italy, can't mask the fact that Eurozone inflation still sits uncomfortably close to 2%, while forecasts indicate that recent growth upticks are temporary. There's that word again. By December, the European Central Bank, ECB, will likely have to trim rates by another half point. Investors. They're already pricing that in, as is the clever Eurozone investor who has started to see what a sinking ship looks like from a distance. Then you've got the elephant in the room, China, where optimism fades faster than those local stock markets filled with retail investors, fed on nationalist rhetoric, betting against a sea of bad structural data. China's policymakers have tried pretty much everything under the sun, from fiscal stimulus to monetary loosening. Guess what? None of it is working. Industrial profits keep falling, with the latest numbers showing September profits declining faster than before. Deflationary pressures are hammering China's corporations to the point where even their balance sheets can't cover up the rot. The PMI data next Friday? That's only going to reinforce the call for further government intervention, which realistically only means short-term band-aid fixes with long-term inflated problems. China watchers, pay attention. Once you've lost the hope of your industrial sector, service and construction sectors can't bail the boat out alone. And amid all the fiscal games being played, the yuan also continues weakening. Capital flight, anyone? As China stumbles, the rest of Asia is in mild panic mode. Thailand, South Korea, Hong Kong all have trade data worth watching, but none show clear evidence that a recovery is happening. This region, fast as it is to industrialize, is fragile when China's services and manufacturing sectors continue to underwhelm. Australia? Yes, it's reporting on price growth, but that doesn't mean it's any closer to cutting rates significantly. Because lower inflation isn't necessarily good if it's not accompanied by meaningful economic strength underlying it. Let's not forget our friends in Latin America, where Mexico's economic growth has been borrowing too heavily from the future only to underperform as we head into 2024. The November data will likely show that Mexico's economy will post its third year of decline by the time 2025 rolls around. What's left to keep producing? And Chile? The labor market slack shows even in the world's #1 copper producer, recovery is just on paper. On the flip side, Colombia has become something of a wild card among Latin economies. Its central bank has extended the easing cycle through 8 consecutive meetings. But there's a skeptical thought here: another rate cut is unlikely to usher in the necessary investor confidence the country needs. Think about the real lesson, folks. Central banks today treat interest rate cuts as if they're economic cough syrup, but when the root cause is systemic rot, productivity drops, wage stagnation, income inequality, debt explosions, and government spending run wild, no amount of rate fine-tuning will solve the real problems. More fiscal spending as a solution will add smoke to the fire, while local players can't seem to fathom how deeply interlocked global supply chains have shattered the illusion that any specific country can rally enough growth in isolation. The US and China have their trade war blues, the Eurozone has debt hangovers, and emerging markets are facing pressures due to both currencies weak against the soaring dollar and declining global demand. Ever wonder why inflation dips only to come roaring back stronger? Or why economic cycles seem out of whack with fewer corresponding recoveries? It's because the main prescription is based on 20th century economic medicine that doesn't quite work in a 21st century overleveraged world. ***. Without systemic reforms, none of these interest rate cuts will matter. It's just shifting deckchairs on the sinking ship. And sooner or later, we're bound to feel larger waves breaking, disrupting what central banks and fiscal policymakers think their tiny lifeboats can fend off. Mary Shelley might call it the Frankenstein economy, a mishmash concept of partial fixes stitched together without fully addressing the essential structural imbalances. You slap a rate cut here, inject some fiscal stimulus there, and hope the monster somehow lumbers forward. But in reality, the stitches are coming undone. And once they do, we're in for some real chaos. Let's dive deeper into what remains largely unsaid in global economic discourse but is the elephant in the room: sovereign debt. Around the world, governments are borrowing at unprecedented levels, and while low interest rates have papered over some of the cracks, the reality is simpler: this system cannot go on indefinitely. Take the US as the poster child here. The federal debt exceeds $33 trillion, a figure so large that it essentially means nothing anymore. Except that it does. The actual servicing of the debt alone, paying interest on what's owed, is consuming an ever greater share of government revenues. In fiscal year 2023, net interest payments on the debt came close to surpassing defense spending, making it the fastest growing major federal expense. Sure, rates go down now, but the past year's hikes mean many loans and bonds that governments issued at lower rates are maturing into higher costs. Sooner or later, the price tag will suffocate fiscal flexibility. In the Eurozone, southern European countries like Italy and Greece, already fragile, are struggling with debt-to-GDP ratios at unsustainable levels, pointing to over 140% in Italy alone. The European Central Bank's interventions only act as a placeholder. The moment they pull off the band-aid, brace yourself for a brutal cutback in public expenditure, or worse, another slow-burning debt crisis. Emerging markets are no better off. The strong dollar eats into their debt servicing costs as they often denominate their debts in currencies they cannot control. Countries like Pakistan and Argentina are already in or flirting with default, while Lebanon has collapsed entirely. Even structurally healthier economies like Brazil and India find themselves teetering as soon as external conditions tighten. And really, this excessive dependence on debt brings us to the most pressing point. Central banks, particularly in developed countries, fancy themselves as the guardians of the global economy. They raise rates to fend off inflation or lower them to spur growth. But this binary thinking doesn't account for today's globalized and interconnected marketplace, where inflation isn't just about local demand, and growth doesn't instantly follow cheaper borrowing costs. In the 2020s, central banks face a terribly mixed environment. On the one hand, they're dealing with legacy issues from the past decade of easy credit, fueled by endless quantitative easing and artificially low interest rates which led to massive asset price inflation without stimulating real, sustainable economic growth. On the other hand, they have to confront the fallout from an ongoing supply chain shock, affecting both raw material availability in labor markets, thanks to events like the pandemic and geopolitical unrest, most notably the Russia-Ukraine conflict. Look at oil prices. They've ricocheted from the $30 barrels of the COVID era to upwards of $90 a barrel at the last check, October 2024. The energy price spikes flow right through the rest of the economy due to higher transport costs and basic goods inflation, squeezing household budgets. And this time around, inflation isn't just fueled by simple consumer demand but by supply bottlenecks, global disorder, and fractured geopolitical ties. Layer on corporate greedflation following companies' opportunistic price hikes, and you've got a spiral that core interest rate policy alone isn't positioned to tackle. Case in point. The near 4% core inflation rate in Europe or the sticky 3+% core PCE price index the US touted last month proves that these pressures reside well beyond the reach of traditional monetary medicine. As much as the ECB or Fed cuts now, they can't loosen the geopolitical grip of rising costs across key sectors. And here's where it gets tricky. Central banks, after raising rates aggressively on inflation fears, are quickly realizing they've slowed the engine but they can't start it back up again that easily. Real household incomes haven't recovered. Corporate investment lacks long-term confidence. The productive capacity of economies hasn't seen the structural improvements it needs. That is, rate cuts won't flip a switch back toward recovery because the deeper flaws remain unaddressed. In essence, central banks are forced into an impossible juggling act of preventing recessions through rate cuts while remaining hawkish enough to battle sticky inflation. But let's be real, they're juggling with fire at this point. Something's going to scorch their fingers before long. Now, let's talk about a more subtle macro force emerging to reshape economic interactions globally: decoupling. In the past decade, global supply chains were hailed as the miracle of efficiency. But frankly, they've become a millstone around our collective necks. The fragmentation of these supply chains, spurred by populist politics, protectionist measures, and geopolitical tensions, think US versus China tech wars, or Russia's war on Ukraine, is now appending decades of trade gains. China, the world's factory, has been the epicenter of this unraveling. Its PMI metrics, unsurprisingly, tell a sobering story of an economy that's slipping. In September 2024, China's industrial profits fell by 8.6% on a yearly basis, signifying more than just a hiccup. This is a country whose economic model, dependent on cheap exports and massive internal investment, is being forced through a gauntlet of structural adjustments. The promise of Belt and Road 2.0 and the Chinese consumer-led growth narrative are, for now, still little more than bumper sticker concepts. Beijing's policymakers must face reality if they want to salvage growth. Further stimulus will only delay the inevitable reckoning. Deglobalization and an exodus of foreign investment, which right now represents around 15% of China's manufacturing sector, hurts badly. How can China pull off dual circulation with domestic demand still too sluggish to sustain local growth? But it's not just China. Germany's factory output is also declining. The revered Mittelstand businesses, which propped up its powerhouse reputation, are increasingly exporting less and producing more for weaker domestic buyers. Both economies, China and Germany, the industrial heartbeats of Asia and Europe, are stumbling. Global growth engines are losing steam just as they're needed most. Globalization hitting reverse means countries cannot rely on trade synergies or foreign labor forces to help smooth out contractions anymore. What happens when everybody starts pulling back into their own nationalist cocoons? Protectionism goes up, efficient value chains go down. And what's it all costing us? A sustained drag on productivity and innovation as companies scramble for new, often inferior suppliers and talent pools dry up. So, the burning question remains, as rates cut or inflate on the whims of short-term policy decisions, can we truly anticipate a global recovery anytime soon? The hard truth is, we're in a slow-burn crisis, globally and nationally. The deck chairs on the monetary Titanic are shifting, but fundamental problems aren't being addressed. Consumers are strapped with debt, real productivity enhancements are faint, and business investment remains uncertain or simply defensive. This is not a recipe for a robust economic future. At best, it's a speculative wager that we can avoid immediate, self-inflicted wounds by treating each brush fire without considering the inferno beneath. So, where are we heading? 1. Debt-laden countries will face sales tax hikes, reduced benefit programs, and growing investor skepticism. 2. Central banks will avoid action too quickly, because that's the prevailing wisdom, right, only for markets to falter under the weight of endless uncertainty. 3. As protectionism rises globally, international cooperation will likely die a slow death, further sinking the long-term value of global trade. Inflation isn't going to vanish, it's going to morph into stagflation light as core aspects of production cost more while demand cannot rise proportionally without labor benefits filtering down. The world can't keep pretending rate adjustments are a panacea anymore. It needs bolder, system-wide solutions, fair labor reforms, productive infrastructure investments that aren't fueled by credit, and innovation that isn't rooted solely in speculative capitalism. But until these real shifts occur, prepare for an economy where we might have rate cuts here and there but real, meaningful recovery? Nowhere in sight. That's all for this scalding economic wake-up call, folks. Central bankers, policymakers, don't say we didn't warn you. Interest rate whiplash is only the symptom, the core disease is the refusal to take real economic reform seriously. Follow the channel, hit the bell, and let's keep unraveling the madness of modern economics together.